Hey, everybody. My name is Jim Kroll, and I am the managing member of the Sage House. I'm really excited for this panel today. These are people I really like to listen to learn from, so I'm excited to get into this with these guys. Guys, would you do me a favor and just quickly introduce yourselves so that everybody knows who's on the call? And maybe, Lance, I just saw you first, so you want to intro yourself first?
Yes, would love to. Thanks for having me, Jim. Lance Dietz, partner at KB Partners. We invest in sports, health and fitness, and gaming.
Awesome. Perfect. Mark?
Hey, Mark Grabowski, founder of Snapdragon Capital. We're consumer focused, I'd say just following growth trends, growth mindsets of both growth equity and growth buyout.
Fantastic. And John?
Hi, Jon Canarick from North Castle Partners, managing partner. We invest in health and wellness businesses within consumer products and services.
Perfect. That's the fastest intro I think we've ever done here, guys, so I appreciate that. Let me just jump right in. I'm sort of viewing this as a way for founders and investors to get into your minds, and I would say that the conversation topic that most has been hitting is what is the state of funding around earlier stage companies in this space? They got bought up really aggressively and then they collapsed down, and now sort of people are asking what's going to happen next. So that's kind of how I'm going to think about these questions. So my first question, I'll ask John this first question. If you think back to 2019, 2020, would you say that there was too much buying and or investing in the space? Was it enough? Was it necessary? Or did COVID make people maybe do some things that were a bit too aggressive in your mind?
I think there was way too much investing in the space by a factor of, I don't know, five times or something to that effect, particularly, of course, in the home fitness category. Irrationally large amounts of capital led to irrationally large amounts of investment in money-losing customer acquisition activities, technology investments that were probably beyond the scale or scope of what was economically feasible for the category. And so as a result, you have billions and billions of dollars of burned capital that are underwater all throughout the home part of the fitness space. Of course, the in-store part, while COVID was happening, was shut down. It was starved for capital, and has of course come back quite a bit since then.
Mark, same question, different context. If you were to look at the space, let's call it in 2021, so COVID has hit. Why do you think money kept pouring in? Was it because people believed that COVID would remain such a key factor? Was it that businesses were seeing such significant growth? What do you think the impetus for that ongoing investment was?
I think anytime there's disruptive change to consumer, whether it's regulatory or in this case, pandemic related, people are, especially the earlier stage, you're paid to make some judgments about what the new world is going to be looking like. And so I think there was overconfidence that this is a whole new world. People are all going to be working from home. There's going to be more remote work. There's going to be people are going to want to now work out at home and not go back to the gym. So there was a lot of look, it's a big category of spend around health and wellness, period, globally. Fitness in particular, globally, it's like a $90 billion category. So whenever you have big TAM, people can make some small assumptions and it can get to really big numbers in terms of penetration. So I think that drove a lot of what John was talking about in terms of dollars coming into the space with some assumptions of how the new world is going to look. And I think that during that period, a lot of people just weren't sure. And I think if they were right, there was a chance to make a lot of money. But I think what we've seen is consumers do go back to old patterns, old habits. There may be some adjustments to those, but there are a lot of elements of communal people. You see employers, even Zoom asking people to come back to work. So it's I think there is there was overconfidence in just that this was a new world.
Awesome. And just if people don't know the term TAM, that's total addressable market. That's just how big somebody's market might be. I'd love to ask all three of you guys this question, starting with Lance. The new normal, so massive disruption, huge money comes in. What do you think the consumer is looking for? I know it's hard because there are a number of different categories, but what are the major themes or principles that consumers are looking for now, kind of heading out of COVID? What do they want to experience and or feel, in this space, in your opinions?
Yeah, Jim, if I could also just add one thing onto the last question. I think I think what was interesting too is fitness wasn't the only sector that saw a massive run up, right? I mean, you saw crypto, you saw teletherapy in the pandemic, again, due to some regulatory change as a result of what happened with the pandemic. So I think it was interesting. It wasn't just fitness, but a few other categories that we saw, massively get overbought. In terms of what I think consumers are looking for, it's stuff that we see anyway at the early stages. And Mark alluded to this, was people still had habits that they're going back to. We think, in-person experiences are very valuable to human nature. And so you see a lot of people going back to brick and mortar, at least what we've seen. And digital maybe struggle at times if you don't have a really amazing hook. So I think that's one thing. I think we lump a little bit of that into the concept of community and how people are building products and services around that, be it in person or digital. And I think, it's a buzzword at times, but it's also one that I think has a meaningful value on or impact on long-term value for user experience. And I think also across populations, which maybe we can get into, where that is maybe even more impactful than others. So that's one thing that we're seeing.
In one or two sentences, what are those populations that you think are feeling that more, Lance?
I mean, I think the one that I'm really interested in, it's a bit out of scope for KB Partners, but just the aging population now, and where community can address loneliness and the ability to be a bit healthier because you have people around you, I think is a really interesting opportunity.
Yeah, interesting. Jon, whether very similar or slightly different, what are you seeing in terms of consumer behavior beginning to come out of the pandemic?
You have some habit change that happened during COVID that Mark referred to as people thinking perhaps was going to be more permanent, and clearly it was not. Having said that, there are hybrid behaviors that do persist, right? So Peloton has had their fair share of challenges, but they still have gained an enormous market share of monthly workouts. Even if they're not growing their user base all that much anymore, they still have a much larger number of workouts on the platform than happened before COVID. And so those all come from somewhere. Yet you're still seeing a really strong recovery within brick and mortar fitness and other areas, as people do want to be with people. And so the significant majority of workouts, of course, are back into the brick and mortar space, while home, though, is bigger than it ever was. I think people have gotten more and more comfortable with guided fitness. If you go to a traditional big box gym, you see people on their phones following routines in much larger ways. Is that because of COVID? Not necessarily. I think it's just because of technology has improved, but people got used to using that stuff during COVID. So I do think it was an accelerator. So habits did change for them, more than not. They have come back to what they were. Boutique fitness is strong. Big box is strong. Not everything, though, is back to what it was either. So there's remnants of COVID days.
Yeah. And Mark, I'd love to ask you the same question too, just in terms of consumer behavior, similarities and shifts.
Yeah, I think a big area we've seen is more investment in just preventative wellness. And so that, I know wellness is a really broad term, But if you think of what COVID did to the healthcare system, I mean, you have burned out doctors and nurses, and it's still hard to even navigate the system and get your appointments. And so I think on the one hand, it created a sense of fear and let me see what I can do to stay healthy. And so that's everything from working out more, it's your nutrition, it's supplementation, to now I really don't want to get sick because look how hard it is to even get through the healthcare system now that you can go in without a mask, but it's still hard to get those appointments. So we're seeing just a lot of, and that hits lots of areas of people being more mindful about what they're doing for their workout routine, making sure that they're moving, what they're putting in their body, how are they helping their mental health too. There's just like all of these things are just much greater awareness of the importance. So I think in general, we think of that as like holistic or, whole body care and that touches a lot of different sectors.
I sure have a lot of my friends who never used to talk about fitness asking me about health span and Peter Attia
Yeah.
and that, and yeah, so I can certainly attest to that. We're certainly on the longevity bandwagon at Sage House for sure. Okay, Mark, back to you. When you think about business models that coming out of this disruption are working or should work, and let's just call it from a profitability standpoint, what are you looking for? What are you seeing that is actually getting to, free cash flow? Or are we still a bit early for a number of these earlier stage companies to be at that stage?
I mean, it's looking at the unit economics is whether it's, a DTC business or brick and mortar business, start there, understand back to, that TAM question and what are they doing to continue to penetrate. Um, I think we found there's still a lot of companies that, maybe the sample size is small and the unit economics work at a small level, but, how do they scale and as customer acquisition costs go up and the model doesn't really work as you get bigger. And again, that's whether it's a, a DTC business or a brick and mortar, you can have those same challenges. So I think we're looking for just a lot of proof points that the model's working. And then, that's just on the financial side, but, why is it working is what we're really trying to uncover. And that's understanding what's the brand proposition, what value are they really delivering to consumers, how differentiated is that, and how will they continue to be able to deliver that service as they expand. So it comes back to like you think about what's the category that they're playing in, what's the differentiation of the company, and then is there a team behind it that can actually continue to execute as it continues to grow.
Yeah, makes sense. Lance or John, anything that you guys would add to what you're seeing getting to profitability, maybe with less friction? Or types of companies, I should say. You don't need to name companies.
Yeah, I mean, I think what I might just add from our view, I mean, we're investing much earlier, right, than Mark and John. Naturally, I think we want to get to the unit economics that are really attractive. But I think when we're investing, we're, as Mark had alluded to, trying to figure out like what leads to that. The two lines that we think about are product versus distribution, and really trying to better understand kind of what about the product itself and how the team is building the product gives them a great advantage that could lead to these like attractive unit economics. And same thing on the distribution side. What sort of experience, network, connection, brand gives them this unique distribution or customer acquisition strategy that then leads to the unit economics that hopefully both John and Mark like and want to invest in. So that's kind of how we think about it at the stages that we're investing.
Okay. And I think, John, you were about to say something too.
Mark and I take a very similar approach in sort of heavy scrutiny there. I do think the only thing I would add, the world has changed so rapidly and dramatically with regards to the cost of capital, that your need to get to cash flow positive faster is just ever more important, because that cost of that burn is much higher than it used to be, which is creating, tremendous capital scarcity, because the alternative places to put that capital now, it's not that hard to earn 10 or 12%. Whereas it was really, really hard to earn 10 or 12% for a decade. And so the alternative uses of capital create a different level of competition and scrutiny for businesses that haven't yet turned the corner.
Yeah, it's such a good point. When you guys, I'll ask one of you guys specifically in a second. When you guys think about the consumer again, a lot of things are starting early with a very niche audience, and a lot of times that audience is high performers, biohackers, athletes, et cetera, et cetera, et cetera. What sorts of products have you seen that do a good job bridging the gap from niche product into more mainstream? A lot of people talk about it's very hard to get from a niche to the mainstream. What sorts of products and or services are you seeing get there?
There's lots of different, I think, examples of that. I guess I would start in the world of recovery, to me, right? Like, so, professional athlete recovery services, whether that was a masseuse, back in many years ago is the only thing there, or ice baths, that then became cryo, right? That has really come down market and become much more available. I think there's still a question out as to the size of that market from a profitability standpoint. I think that's still a big open question, but in terms of availability, and then of course this sort of sister world or sister category to that is the tracking, right, with Aura and Whoop and the various companies in that space, where these things are fairly mass available now. You don't necessarily need a full-time professional on the sidelines clocking this or taking blood for that. There's incredible data out there that has made its way at least into the heavily engaged community. I do think there is a limit to how deep it goes, because people that are not physically actively engaged, what are they, the care about measuring that is going to just naturally be lower. Your willingness to spend is going to naturally be lower. Your need to recover is naturally lower, right? So I think those are the best examples of things that went from the very tip of the pyramid down to at least a semi-mass level. Fitness services itself have many examples, but those are, I would say, decades old at this point.
Yeah, I'd agree. Like the tracking, they've been able to make much more mass products, right? And they see the athletes with the Whoop, or like you said, the Aura, or things like that. But I think the other area you're seeing outside of just like the athlete or the aspiring athlete, weekend warrior type, is a lot of the testing. So when you think of like everything from blood testing to stool samples, like people there, you're actually addressing some different issues. It's not about just like, am I optimizing my workout performance? It's like, no, I've got some like allergies, chronic issues, immune responses, like other things that people are dealing with. This is back to what I was saying before of like managing your health and taking ownership yourself, rather than, waiting for a doctor, waiting for an issue and having an isolated identification, but actually trying to be more proactive in measurement. And I think that there's been a lot more, or there's been expansion of testing opportunities. I think a comfort level, even just getting lab work done, that maybe going to, giving your COVID test, really opened up a lot of that market as well.
Lance, want to throw an idea in?
I'm happy to add on. I think maybe themes that we've thought about, like just kind of things that have become fun or very easy. So I think Whoop is a great one that you guys alluded to, where it started off being something for elite athletes, with Michael Phelps and LeBron James, and then it was a 10-year overnight success where like my mom had heard of Whoop, right? So, and I think just the fact that it made it so easy to kind of think about sleep, for example, or if you drink alcohol before you go to bed, you're not going to sleep well. Like visualizing that, I think also made it a little bit of a game in which people are like, I kind of want to see like my score be great in the morning, so I'm not going to, drink before I go to bed, or I'm going to go to bed early. So I think some of those components we've found to be like pretty interesting as it relates to which sort of products, services, et cetera, maybe have a good opportunity to get to the mass market.
I want to ask kind of a bit of a gray question. I know it's a tough one to answer, but do you guys see the space accelerating in the near future, or do you think this is going to take a while to speed back up? Now, I'm just going to make the assumption that nobody here believes that we're going to go back to 2020 levels of investment. If you disagree with me, please tell me. But are you seeing the space speed back up? Do you think we might need 12, 24, 36 months to see that? Or is this is the space, let's call it, going to remain at this pace? And maybe Mark, I'll ask you first.
I think it's going to depend on the sector. So it's a pretty broad area. I think, some areas that have been overinvested, you're going to have to see, are there mergers or the companies that shut down? Is there just some cleansing that might take place? There's emerging category sectors where you're seeing more spend and continued spend going to it. So, I think we were talking before about like aging population. Like that is certainly an area that you're seeing more dollars go towards. How do you deal with that? The statistics are enormous, right? It's like, I think 10,000 people turning 65 a day. So that means just like what looks interesting may shift. But I think there's probably general consensus, like health and wellness, broadly speaking, is still an upward and to the right trend taking place. And I think some sectors are above pre-COVID levels and still growing, and some sectors are just getting back to pre-COVID and growing. But I think almost universally, there's growth in consumer expenditure in health and wellness across multiple categories. It's just, where has there been maybe too much investment? Where is there more emerging opportunity?
I'll add that I don't see an acceleration of growth in many categories, partially because of the cost of capital issue, right? So you're getting approval from your board to build the 10th store, that year. It has a higher bar, right? Because the cost of capital is just higher. So the ROI better be higher or less risky, one or the other. And so I do think that slows down. I think capital into riskier ventures slows down just because of, again, that cost of capital. But in general, the demand for longevity, health and wellness, taking control of your health, as Mark has alluded to, I do think leads to reasonable and strong continued growth for the category. But I'm not sure I see a major acceleration, except when you have massive breakthroughs like the world of Ozempic. And that came out of, it didn't come out of nowhere for people that have been following the space for a long time. And certainly the podcast folks that you referenced earlier have been talking about, versions of those drugs, and we'll see where that all goes, right? Is that the panacea that it appears, or are there going to be massively negative side effects in the future? Don't know, but that has opened up a completely new tool, really, in the fight for health and wellness and longevity and whatnot. So, investment there, of course, is through the roof, right? They can't keep it in stock.
Guys, we got one more question, so I appreciate you sticking around. I wanted to ask a question around due diligence. I hear all kinds of different stories about how people do or do not do due diligence, and of course, at later stages, there's a much more formalized process. But when you guys are thinking about due diligence today versus let's say 2019, what has changed today, and what are some of the most important items that you're looking for, understanding that each play is unique? Lance, why don't we start with you?
Sure. Yeah, no, I think naturally, like a few things have changed. Time from first meeting to a term sheet in our world has lengthened, of course, which allows you to spend more time with the founding team, which in our stage is probably the most important thing. We have to believe in the vision and the product and the tech and the offering, but we know things are going to change from the seed stage, to them being super successful. So we're banking on the team being able to iterate and putting a lot of faith in them. So having the ability to spend time with them, do more references, et cetera, it's nice to have that extra time now than, prior to COVID when things were getting done within a week or two. But I also think like there's a diligence aspect to it, but there's also just, I think at some point, like things were getting bid up so quickly, as we've talked about, that wanting to not miss out on the next great opportunity that we thought might have been there, maybe was like the main, issue or question, and not wanting to lose out on that, which then when the valuations came back down to earth, maybe it wasn't a diligence question. It was more of a, did we pay the right price question. So I think it's a mix of both, which makes it a bit tricky.
Jon?
Yeah, I mean, at the mid to later stages, I'm not sure it's changed all that much. I mean, I guess what has changed is views on valuation, more so than the level of due diligence. And Mark talked earlier in this discussion about unit economics, right? And whether that was D2C unit economics of one or a store in a retail play. I mean, there's an enormous amount of time spent on those things and understanding the believability in an upward rising cost environment. Perhaps living in inflation has caused, more careful modeling of scenarios like that, which really haven't been a huge factor, or interest rate explosion, which hasn't been a huge factor. Time with management team, as Lance referred to, has always been super critical. Now, things did get done during COVID on Zoom in the private equity industry, which is almost unimaginable, just given how important it is to know who you are backing, know who you are investing with. And so, that's returned to sort of pre-COVID, I would say, but I don't know that it's gotten tighter necessarily. I think the slowdown in M&A volume is as much to do with, believability around what things are worth, more so perhaps than spending an additional month on due diligence or just concerns that the economy is about to go south. Something we've all been wondering and watching for months and months and months now.
Awesome. Mark?
Yeah, I'd echo what Jon said about just maybe return on capital. There's a even greater emphasis on proving you have a line of sight to profitability or to just great return on capital. I mean, that's always been there, but it's even more important. You're I'd say a little less willing to give you time to get there on some of the earlier stage things. But I think what I've seen probably change is the pace of change continues to accelerate in terms of just everything our companies are dealing with. So, if it's not the pandemic, then it's inflation. If it's not inflation, you've got, what's going on geopolitically. So I think seeing management teams who have proven adaptability there's an even bigger premium. Like one note players are not as backable. If it's just we've got one play and we're going to keep running that over and over. I think you've just seen you need to be really adaptable, and that's hard to strike that balance, because you have to sometimes make some decisions without perfect information. We as investors try to make sure we have as much information, but there is some entrepreneurial element that I think is even more important for our executive teams to be able to execute.
Guys, I really appreciate this. We are out of time on this. I selfishly would love to ask you about 50 more questions and go down the rabbit hole on all of them, but thanks so much for your time, and I'm sure people took an awful lot from this. So it's good to see everybody, and I hope to see you guys soon.
All right. Thanks.